And Lotfi, this idea of the Treasury market having some liquidity issues, that's been one of the top concerns you've been watching, too. One of the biggest risks facing the markets right now, right?
That's right. I mean, so far we've seen a big decline in bond prices that is entirely reflective of the move higher in yields. We've seen widening in spreads, and I say it's somewhat modest, actually. And I think unlike March of 2020, credit has been sort of following the equity market as opposed to the other way around. But you're absolutely right. We haven't seen yet evidence that the market microstructure is becoming challenged, that the price discovery process is becoming problematic for investors. Hopefully that will not happen. But if that happens, I think that kind of brings us back to where we were in that first quarter of 2020.
Lotfi, I hadn't really thought about it until Steve was just talking about it, but it has to make it more complicated for the Fed to be raising rates, for the bond markets to be moving, yields to be moving up so quickly, and knowing that the Fed is going to be stepping out, and it's been the biggest buyer for a long time.
Absolutely. Not only that, but keep in mind that the exit is also synchronized this time around. You have the Fed obviously starting the run off the balance sheet, but at the same time, you have the ECB in Europe ending the APP and potentially delivering two back-to-back 50 basis points hikes. And so, yes, the path of the exit is a lot more front-loaded in the U.S., but it's also a lot more synchronized in Europe, and that clearly poses challenges from a market plumbing standpoint, in addition to broader risk sentiment.
Those are the two of the risks you're worried about. The third would be a faster than expected erosion of corporate margins. And everybody is kind of watching and wondering how margins will hang in when earnings season begins again in just a few weeks. What's your guess? Are they going to be able to pull it off, corporate leaders, just in terms of maintaining those margins, or will there be more pressure? Will estimates have to come down?
Well, if the first quarter earnings seasons is of any guidance, I kind of feel like we had two seasons in one a little bit, where the late reporters sent a much more negative signal than the early reporters. That's something that I would keep an eye on. But at a very high level, you almost have a double whammy of slowing down consumer demand and then all sorts of pressures on the cost side. The net impact of that is pressure on margins. And that's one of the reasons why we would be aggressively positioned up in quality owning companies that have the ability to preserve earnings in the face of a variety of challenges here, both on the demand and on the supply side. But the risk from a credit standpoint is that erosion in margins happens a lot faster than expected, and then it kind of changes things from a credit quality standpoint, because I would say so far we're going into this in a position of strength from a balance sheet standpoint. If you change that, then investors will have to reprice the price of credit risk.
Shepard Smith here. Thanks for watching CNBC on YouTube.